Two people graduate the same year. Same job. Same salary. Same advice from every finance book on the shelf: keep 6 months of expenses in cash, untouched, forever. The first one listens. Builds it, protects it, never lets it drop. For 30 years. The second one builds it too, but only ever keeps 1 month in cash. The rest goes into the market year after year, including the years he has to dip into it for real emergencies. 30 years later, the second person is ahead by more than $180,000. Not because he got lucky. Not because he avoided emergencies, he had just as many as the first person. He came out ahead because of what he did with the money the emergency fund rulebook told him to freeze. I'm not going to ask you to take that on faith. Every number in this video was run before I said it, because here's what almost nobody in personal finance says out loud: an emergency fund isn't free. It has a price. Most people just never see the bill, because it's paid in money that was never allowed to grow, not money that visibly left their account. This video is not an argument against having a safety net. It's an argument for pricing it correctly. Once you see the actual cost of cash, you can decide, on purpose, how much of it you actually need. And that number is almost always smaller than the one you've been told. Law 1, certainty has a price, and it's payable in compounding. Start with what cash actually is. It is not safety. Safety is what cash buys. What cash is a decision to opt an amount of money out of growth, permanently, for as long as you hold it there. Run the numbers. $20,000 sitting in a high-yield savings account at 4.5% for 30 years becomes about $76,000. The same $20,000 invested at a historical market average of 8% becomes about $201,000. Same starting dollar. Same 30 years. The gap between those two numbers, $125,000, is not a loss. Nothing was stolen from you. But it is a cost, and it is real, and it is the exact price of certainty. You paid it in growth you never got to see, which is why almost nobody notices they're paying it at all. This is the first law: cash doesn't sit still, it goes backward relative to everything else compounding around it. The size of your emergency fund is not just a safety decision. It's a compounding decision, and compounding punishes anything held out of the game. Law 2, inflation is a tax with no due date. Here's the part the 6 months of cash rule never accounts for. Inflation doesn't ask permission, and it doesn't wait for an emergency. At a typical 3% a year, a $30,000 emergency fund isn't $30,000 in 10 years. Its real purchasing power has quietly shrunk to about $22,300. You didn't spend $1 of it. You still lost nearly a quarter of what it could buy. Now compare that to the same $30,000 invested at 8%, adjusted for that same 3% inflation, a 5% real return. 10 years later, it's worth about $48,800 in today's dollars. One number shrinks while you're not looking. The other grows while you're not looking. That's the whole difference, and it runs in the background of every year you hold idle cash, whether an emergency happens or not. This is the second law: cash isn't neutral. It's a slow leak. The emergency fund doesn't just fail to grow, it loses ground every single year it exists, guaranteed, regardless of what the market does. Law 3, more isn't safer, it's just slower. So if 6 months feels safe, why not a year? Why not 2? This is where people quietly wreck the math without ever running a bad number. Take someone with $4,000 in monthly expenses. 6 months is $24,000. 12 months is $48,000. That extra $24,000, held in cash instead of invested over a 25-year runway, is the difference between roughly $205,000 and $103,000 at retirement. $100,000 spent entirely on doubling a cushion that, statistically, will almost never need to cover more than a few months at a time. Here's the reversal almost nobody runs. The actual median length of unemployment in the US sits at a few months, not a year. Building a fund sized for the rare, extreme case means paying the full compounding tax every year, for decades, to insure against a scenario that, for most people, simply doesn't happen the way they've planned for it. This is the third law: the size of your fund is not a safety number, it's a bet on how bad your worst year will be. An oversizing that bet is itself a risk, just one that shows up as a smaller retirement instead of a bounced rent check. Law 4: liquidity has tiers, cash isn't the only kind. Here's the assumption the whole cash-only rule rests on, that when the emergency hits, cash is the only thing that can save you. It isn't. It's just the slowest, most expensive form of protection available. A paid-off line of credit sitting unused costs you nothing while it isn't tapped. A taxable brokerage account can typically be liquidated in a day or two, slower than a savings account, but fast enough for almost any real emergency, and it's been compounding the entire time you didn't need it. Even a 401k loan, in a true crisis, is an option most people never model into their plan. Run it, keep 1 month of true cash for the truly instant stuff, back it with a brokerage account you could sell out of in 48 hours, and back that with a line of credit you never intend to use. You've built a safety net with almost as much protection as the 6-month cash pile, and left 5 months of money outside, compounding the entire time. This is the fourth law, and it's the leverage law from the other direction. Liquidity doesn't require cash, it requires access, and access can compound while cash cannot. Law 5: the real risk was never running out. It was selling at the bottom. Here's the one exception that actually matters, and it's the reason this isn't a video telling you to keep $0 in cash. The real danger was never a modest emergency. It's a real emergency landing in the same year the market is down 30%. If your only backup is your invested money, you're forced to sell into the crash to cover the bill, locking in the loss permanently, at the exact moment patience would have paid you back. This is the same mechanic as a margin call, just self-inflicted, a forced sale at the worst possible time, caused not by leverage this time, but by having zero buffer at all. This is why the honest answer isn't no cash. It's precisely enough cash, and not $1 more. Enough to survive a bad month or two without selling anything, layered with access to more if things run longer, and nothing beyond that sitting idle out of fear instead of calculation. This is the fifth law: the goal was never to hold the maximum amount of cash. It was to hold the minimum amount that keeps you from ever being forced to sell. Everything past that minimum isn't safety. It's an idle bet against your own future compounding, and it's a bet you almost always lose. Put the 5 together. They're not 5 separate opinions. They're one system. The first 2 laws are the cost: cash loses to compounding, and loses again to inflation, every single year, guaranteed. The third law is the sizing mistake: bigger doesn't mean safer, it means slower, and most funds are sized for fear instead of statistics. The fourth law is the fix: liquidity doesn't require cash, it requires access, and access can compound while it waits. The fifth law is the one honest limit on all of it: a small buffer against being forced to sell beats a large one sitting idle, every time. And it collapses into 4 questions before you decide how much cash to hold. 1. What's the actual cost, in lost compounding, of every extra month I keep in cash? 2. Am I sizing this fund against a realistic bad year, or against a worst-case story I've never checked? 3. Do I have access to money, a credit line, a brokerage account, that could stand in for some of this cash? 4. Is the amount I'm holding the minimum that keeps me from being forced to sell, or is it bigger than that out of habit? If you can't answer those, you don't have an emergency fund. You have a fear tax, and you've been paying it quietly for years without ever seeing the bill. At the start, I told you the person with less cash came out $180,000 ahead. You've now seen why. Not because emergencies don't happen. Because the price of protecting against them was never zero, and once you can see the price, you get to decide, on purpose, exactly how much of it is worth paying.